out of that trifecta of influences, what is most notable to you at the moment? What's the most powerful factor that we're seeing moving the markets? We know the China story is a major one today.
Yeah, morning, Heidi. I would probably say, yes, keep an eye on how China's COVID pivot progresses. I expect it's going to be quite chaotic, confusing, certainly for the markets, maybe 2 steps forward, 1 step back. It's obviously completely uncharted territory. As you was just mentioning, over the weekend, we had some more cities starting to ease testing requirements in terms of how public is allowed to access some of the public spaces and so on. And look, as the second largest oil consumer in the world after the US and the single biggest contributor of demand growth, clearly China is key for the oil markets. The problem here is there's going to be lots of uncertainty and unpredictability around its COVID pivot.
When you take a look at the dynamics of crude pricing, the sanctions that take effect today, are they going to make a meaningful impact on pricing?
I know it's the price cap. I mean, in a way, I guess politically it saves face for the EU that they actually managed to agree on a number. But for all practical purposes, it's completely immaterial. Even as the price cap has been set currently at $60, it's about $5 above where Russian crude has been trading towards the end of last week. So it's certainly not going to achieve one of its critical aims, which was to try and crimp Russian oil revenues. If they were trying to ensure that European shipping companies, insurance companies, P&I clubs sort of remain in the game, continue to have that business of Russian crude flowing into third countries, I don't think that's going to happen either, because China and India have remained non-committal, and I don't expect them to sign up now either. The third intent was, of course, to try and avoid a supply crunch and a price rally. Well, that's not happening, but that's more because of demand concerns and China demand concerns and economic downturn rather than as a result of the price cap. So it's really, as I said, it's immaterial.
So, Vandana, you say the second big pivot to watch is the Fed, and of course, after the Friday numbers, the pivot is not expected by Fed watchers to be weaker, going back from rate hikes. It's expected to perhaps making them even go higher and last longer. What does that mean for oil?
So, Kathleen, this is definitely another sort of choppy waters there from a very broader financial markets are going to continue speculating and moving up and down, and a great deal of volatility. Now, what we've seen in the past few weeks is that oil hasn't always moved in lockstep with the return of risk appetite in the financial markets with regard to the Fed pivot. On some occasions it has, on some occasions it hasn't. By and large, a Fed pivot, if the euphoria is back in the market, or as and when it is back in the market, that is a prop for crude, because we see that typically, well, of course, that gives investors a bit of relief in terms of how badly the U.S. economy might be affected. So that's a positive for oil demand. And it typically batters the U.S. dollar, which also ends up being a prop for crude prices. But again, so first of all, I don't think personally that this Fed pivot story is going to be concluded one way or another in terms of market sentiment. And second, we won't always see a positive correlation. So that's another uncertainty out there.
You say that barring any rude surprises with Russian oil flows, you expect pressures to remain under downward pressure because of the onward, the global economic slowdown and the heavy discounts on those Russian products.
Exactly. So, as of now, I think the EU has put the cap is about looking to put Russian crude at about $20-25 discount to Brent. But going forward, obviously the freight rates are expected to rise because there's going to be fewer ships in the pool available to move Russian crude if EU shipping companies remain out of this trade, as I expect them to. So freight rates are going up. As a result, the buyers like China and India are going to ask for deeper discounts for Russian crude to offset their higher freight costs. And look, Russia's market is shrinking, right? So more than 1 million barrels per day that was still going into the EU as on a seaborne basis is now not going to go into that part of the world. So there'll be more barrels and fewer buyers for Russia. So I expect actually the Russian discounts to continue sinking, basically higher discounts.